The energy sector has been absolutely tearing it up this last year as oil prices continue to rise with still no end in sight. It can be difficult to figure out which oil companies are the best to invest in when they all seem to be heading to the moon. One possible solution to help you choose is to look at energy sector ETFs, and we will do that right now. Some investors love taking the time to research individual stocks and build up their portfolios by adding them one by one. There's nothing wrong with that, as my style does lean in that direction. However, an ETF can help take the guesswork out of diversification into a chosen sector. When that sector is booming, it can be a great way to get in faster with a broader exposure. The energy sector has been on steroids, provided we are talking about oil and gas. Renewables are absolutely the future, but in this boom, they're on the back burner, and they're on low heat. They're not even keeping up. I have found 5 ETFs, 4 from Canada and 1 from America for our Wealthsimple Plus fanatics. These ETFs do have a good amount of oil and gas exposure, so you know we are going to see some big numbers. Without any further ado, let's slant drill our way into our first ETF. First up is the Horizons Pipelines and Energy Services Index ETF with a ticker of HOG. Of course, you want to make sure you're on the TSX for this one, because if you're on the New York Stock Exchange, you're looking at Harley-Davidson. This ETF was designed to provide exposure to equity securities of Canadian oil and gas companies in the midstream sector. Their top holding at nearly 10% is Secure Energy Services. They have a market cap of $23 million, and they do have a yield of 2.233% that is paid out quarterly in the amount of 64 cents per share. They have an expense ratio of 0.64%, which is pretty solid. In the last year, their stock rose from $9.42 to $10.35 for a return on investment of 9.9%. When you add in that dividend, you get a total return of 12.1%. That is a solid return. But with the boom the way it is, I have a feeling we can do better than that. So let's see how we fare with the BMO Equal Weight Oil and Gas Index ETF with a ticker of ZEO. This ETF seeks to replicate the performance of the Solactive Equal Weight Canada Oil and Gas Index. A few of the companies they have significant exposure to include Cenovus, Suncor, Imperial Oil, and Canadian Natural Resources. They have a market cap of $302 million, and they have a yield of 2.231% that is paid out quarterly in the amount of 45 cents per share. They have an expense ratio of 0.61%, which is pretty average for this sector. In the last year, their stock rose from $44.20 to $71.27 for a return of investment of 61.2%. Now, when you add in that dividend, you get a total return of 63.4%. That is a pretty awesome return, and I think we have already kept that promise of doing better. But we have 3 more ETFs even better than this. Go figure. Up next, we have the Horizons Crude Oil ETF with a ticker of HUC. This ETF tries to replicate the performance of the Solactive Light Sweet Crude Oil Winter MD Rolling Futures Index ER. They do use the futures market, but while oil is booming, this is a fairly safe play. They have a market cap of $54 million, and, they do not have a dividend. This one is actually 100% a growth play. Their expense ratio is 0.88%. In the last year, their stock rose from $14.62 to $25.20 for a return of investment of 72%. That is not bad at all, but with the lower market cap and the dabbling into the futures, I would be a wee bit more cautious with this one, especially if it looks like the boom is coming towards an end. For our second best ETF for today, we are going to dip down into the US for the Investo S&P 500 Equal Weight Energy ETF, which has a ticker of RYE. This ETF invests at least 90% of its total assets into the S&P 500 Energy Index. So you can be sure that this one gives you a very broad exposure to the entire American energy sector. They have a market cap of $694 million, and they do have a yield of 1.606% that is paid out quarterly in the amount of 42.2 cents USD per share. This is a serious growth stock, so no worries on the smaller dividend. They have an expense ratio of 0.40, which is absolutely not too shabby. In the last year, their stock rose from $43.40 to $77.50 for a return of investment of 78.6%. Now, when you add in that dividend, you get a total return of 80.2%. This is just absolutely crazy. And yet we still have one more ETF, a Canadian ETF, that beats this return. Our top ETF is a long-term favorite of mine, and we've seen it on this channel more than once. It is the iShares S&P TSX Capped Energy Index with a ticker of XEG. They are all about the return of long-term capital growth as they replicate the performance of the S&P TSX Capped Energy Index. Their number one holding is Canadian Natural Resources Limited, which makes up nearly 25% of this ETF. They have a market cap of $2.6 billion, and they do have a yield of 1.172% that is paid out quarterly in the amount of 7.5 cents per share. Keep in mind, this is a capital growth stock, so that meager dividend is simply icing on the cake. They have an expense ratio of 0.61%, which, trust me, is insignificant for the returns I'm about to tell you about. In the last year, their stock rose from $9.21 to, wait for it, $18.02 for a return of investment of 95.7%. Now, when you add in that dividend, you get a total return of 96.9%. Holy banana bread. This is an awesome investment that would have nearly doubled your money. Full disclosure, I have done well with the stock. The big question is, how long can this sector keep it up? That is very important, as once this boom ends, the opportunity for easy oil money will dry up like an overpumped well. The only thing we know is that the overwhelming expert opinion on this matter is that the boom still has some gas left in the tank. Some believe it will persist for the remainder of 2022, and that could be true. I always approach it as I pay attention to the news and the market and never be afraid to take profits. When the boom ends, prices will of course come down, but if you've been taking profits along the way, you will be sitting pretty. Always keep in mind that I am just the beginning of your research, and your financial advisor is the end. If you guys loved this video, be excited. There is way more to come. Until then, why not watch one of these videos? And before you jump into that content, just be sure to like and subscribe to support the channel. I'll see you in the next video.